Excuse me. Bring that to the real fun. Hi, I'm Will.
Nice to meet you.
Is it goes to prove concept. Once you get come over accepting your all right. Then you just scroll to the market research.
It's so great to meet you.
Good to be here.
All right, very thankful for y'all to be here. Thank you so much. So what we're gonna do,
Which would be stage 5.
what we're gonna do is we're gonna have you all do a quick introduction. So who you all are, who you represent, and then maybe a quick fact that maybe people don't know about your programs. So I'll let Kevin, if you want to kick us off.
Sure.
We'll go around that way.
Kevin Roddy with Pinnacle Bank. Pleasure to be here. We've been a long-time supporter of the Entrepreneur Center in Washington, D.C. and every other organization that supports entrepreneurs and small businesses. To spare you the full Pinnacle commercial, we're a great entrepreneurial success story ourselves, and started the bank in 2000. I did not, unfortunately, but several others that I work with did, and we've grown into a very large bank in 8 states. My task is making sure that our large bank feels small to entrepreneurs and small business owners that we serve. I've been there 17 years. No really interesting fun facts about me. Something that's interesting or unique to Pinnacle.
Yeah.
We are the largest SBA lender in the state, so just sort of keep it on point. That is, thank you very much. Okay, and there you go. I'm gonna stop there. It just goes down.
Hey everybody, I'm Michelle Wooden. I'm with Old National Bank. I've been in banking for about 27 years. Old National is fairly new to the Nashville market. They are based out of Indiana. I would say that one thing that is a little bit different about Old National is that we do have a program that is specific to women and minority-owned businesses. So we specialize in small business across the board. But that is a program that's specific to women and minority-owned businesses that kind of sets us apart from other banks.
Hey everybody, thanks for letting me join. Kelly, thank you for tapping me last minute and letting me join the panel. My name is Will Carter. I am, I think, maybe the only non-banker up here. I'm not a lender or a banker. What I do is invoice factoring, which we can get into here in a minute, but comparable cash flow solution for borrowers that need liquidity. Just a little bit different from banking in a couple different ways. But my office is based in Memphis. It's Carter Funding is the name of our company. Been in business since 1994. And generally we're working with companies that have revenue, less than 10 million. Generally my clients have a capital need of somewhere between 50 grand and in some cases 10 or 12 million. But, most of what we work with is, early stage, super fast growth, and a little bit of turnaround as well. So we'll get into that in a minute. Thank you for letting me be here.
Thank you. Hello, my name is Charlotte Peacock. I'm with Republic Bank, and I am a banker for over 27 years. Republic Bank is a 43-year-old bank headquartered out of Louisville, Kentucky. And one of a fact that I love about Republic Bank, it was started by entrepreneurs back in 1982. So they had a hard time getting financing and what they were trying to do, so they decided to start a bank. So.
Hi, Shay Wood. I'm with Pathway Lending, and we are a CDFI, which is a Community Development Financial Institution. And so we work with a lot of these guys up here when they are unable to get a deal done. They will oftentimes refer it to us. We are very mission-driven. We look to help underserved communities and borrowers. We also do not hold deposits, so we are just there to help bridge the gap from a lending perspective. A fun fact about me, I'm born and raised here in Middle Tennessee. I used to be in SBA lending and recently made a change when I had kids, so I didn't have to travel as much. So glad to be here. Thank you.
Give it up for our man. Alright, and you all do have a couple of mics that are beside you all if you want to pass as long as we go through. I just have a couple of questions just to kind of get us started before we go into the matchmaking. Just kind of some very broad questions just to get us started. So one of them is, So how does a startup know if they're ready to apply for a loan? Like what makes that key moment? They're like, okay, I think I'm ready. I need to go ahead and see what options are out there. Whoever wants to take the first, give a quick.
All right. Startups just, if you think about, take a sort of a high-level view of the capital continuum. It's really a function of risk and reward. Bank debt is the cheapest form of debt. It's non-dilutive, but it's also the hardest to get, simply because our source of capital are deposits. And I think you probably already know that, But I mean, at the end of the day, our bankers in the room, as we make a loan, our first question is, how do we get this money back? And make sure we can get the money back. And so the other end of the continuum is investors, venture capital, private equity, whatever that may be, who can take a lot more risk because of their source of capital and also paid to take that risk. Here ends the capital continuum story, but from a bank standpoint or any lending standpoint, from a bank standpoint specifically, as you start your business, I think the first question is one, what is my plan towards profitability? Just like you would, talk to a banker, same conversation you have with bankers with an investor. What is the plan? What is my value-added proposition? And if I'm looking for that cheap form of capital, namely bank debt, then if I'm going to a banker, what can I show her to show that I can in fact pay this loan back? Typically, a startup, you don't have historical financial information. So then the question becomes, is there another source, a spouse, a rich uncle, or whatever that can backstop that loan that the bank can underwrite to give us the confidence that you can pay us back? So I'm not sure if that directly answers the question. We get a lot of startup requests, and quite frankly, most of those we can't accommodate. What I try to do is is direct them to alternative sources of capital, debt capital that would be more appropriate. Right.
I can speak really loud. I'll kind of add to that. One thing that I think a lot of borrowers don't take into consideration is their liquidity. There's going to be some sort of equity injection that's required from your banking or lending partners. And we don't want that to utilize all of your access to liquidity. So as you're thinking about that and putting your business plan and your projections together, that's one thing that I see that people don't always think through. So just know that there's going to be some sort of equity injection requirement. I would say anywhere from 10 to 30%.
Can I add to that? Another way you can tell if you're ready to go to the bank is when you have no cash, but people owe you money. And it's going to take 30, 60, 90 days for you to get that money. So at that point, it's time for you to say, okay, maybe I need to go to the bank, because you can pledge those receivables as collateral and see if I can't get a line of credit to help me keep moving so I don't have to stop when I'm not getting money in. It's another way to look at it.
Yeah, I would maybe echo Charlotte's sentiment. So I'm different from these guys, and I didn't mention this, but I was a banker for 12 years. I started my career doing commercial lending for Regions out of the Memphis office. And I guess what I do, my form of capital is a little bit different from banking in that we can help companies that are not profitable or pre-profit in most of y'all's cases. Generally, that's going to be a tougher sell with a bank. Now, I can't help you if you're pre-revenue, because mechanically what I do is I purchase invoices from you. So if, as an example, if you bill one of your customers $1,000 for whatever the product or the service is that you sold, I'll purchase that invoice from you and your customer would pay me directly. So my underwriting is really more tailored to your customers, because I'm relying on that company to pay me back as opposed to relying on you to pay me back. So that's the biggest difference in what I do and what the other four folks up here do is their underwriting is going to be more based on your business's financial performance, your cash flow, your balance sheet. And my underwriting, like I said, is really more about your customer's financial strength, their cash flow, and their performance.
For Sure. All right. So just kind of like piggyback off that a little bit. So when they're looking to, see if this is the right option for them, they may need to distinguish between a couple of different options. So let's break down a little bit. How do traditional bank loans differ from like SBA loans or micro loans or things like that?
Start. I can talk about that. I've done both. On the conventional side of the house, you're typically going to be looking at historical financials. So there's going to have some sort of proven track record. Sometimes on the conventional side, they will lend towards projections, but for the most part, it is historical based. They want you to have a good amount of time in the business, have good liquidity, good collateral, all the things, all the stars align, right? SBA lending will take on a little bit more risk. So they can do startup financing for SBA lending. You can do change of ownership, business acquisitions. They can do working capital loans and lines of credits. And they can utilize projections in making those credit decisions. Pinnacle is a great SBA partner. I know there's a couple of others that I won't mention, but they do a great job with their SBA loans. I used to come up in competition with them a lot. It's all about kind of the risk profile. The bank is going to take the least amount of risk in the three scenarios. Then SBA will take on a little bit more risk. And then you have your non-bank lenders where for us, we are mission driven. So as long as it falls into a low to moderate income area or it's a minority owned business, then we will bend over backwards to try to make the deal work. We have done some deals with bad credit. We have done some deals where cash flow is sub 1, but we see a path to getting it to a passing cash flow. So I would say we take the loans that SBA can't do for whatever reason and that the conventional banking partners won't do for whatever reason, whether it's collateral shortfalls or credit concerns or cash flows declining, whatever the trends may be. But so I would say that's kind of the order from a risk profile perspective.
Well, I also would add, I think a lot of conventional banks vary. So every bank is different. So, Pinnacle might be great at certain industries while Old National is great at other industries. Or, for example, with our empowerment program that I mentioned, we take on a lot more risk in that program. We do quite a bit of startup funding. So for a conventional bank, that's not, very traditional. So I would just encourage you as you are meeting with bankers, interview banks and bankers and find out what bank is good at what and ask a lot of questions on the front end before you actually, go through an application process with them or let them run your credit. And just have very thorough conversations about what they have to offer and what programs they have before moving forward. And that will save you time and your credit and help you find the right banking partner.
All right, anyone want to piggyback onto that? No worries. And so that leads me to, what do banks, or what does your bank typically look for when evaluating a startup to be accepted for an application?
Great business plan.
Yeah.
Well thought out business plan with great projections, not projections that show you're gonna be in the negative, because that's
Yeah.
that's all it is.
Have you ever seen a projection that shows that?
I've never seen any of them. They all look amazing.
I've had a couple that had negative.
Well, I mean, out the gate maybe, but it's
So you gotta go back and do their homework again, but a great business plan. You also want to be able to inject something, 10, 20% of your own cash, because we don't want, we want you to have some skin in the game as well. And make sure you understand, and I know it's so easy, and we've got ChatGPT and Copilot, and you even have companies that'll write your business plan for you. There's nothing like sitting down with somebody, going through their business plan and asking a question and they have no idea what you're talking about, because they didn't write the business plan. So make sure you understand what the business plan has in it, because they're gonna ask. If I don't ask, my underwriter's gonna ask, and then I'm gonna ask you. So make sure you understand what's in that business plan.
And to piggyback off of that experience, We want to understand how your current experience is transferable to this new startup. So whether it's direct industry experience or you've got experience managing a P&L, so you know how to do that aspect of it. We really want to dig into your background and want you to have some sort of experience as well.
And also, when some people look like they haven't injected any capital in their business, but they actually have, but they haven't done a very good job of keeping the personal and the business separate. So, from the beginning, you really should keep your business and personal separate, and then you can really show a track record of what have you actually injected in your business, because I'm sure you probably have injected more than what you even realize.
From our standpoint, I would agree with everything that was just said, but we, and I think y'all do too, every other federally regulated bank has to see some sort of historic cash flow for that loan. So while we can look at projections and expect them for a conventional loan, SBA can be a little more reliant on it. We have to see if you're asking for a $100,000 line of credit, well, can this person or who that person brings to the table from a guarantor standpoint, can we cash flow this loan, any other debt they've got, new requests and any additional debt. So that's why I'm saying, it's from a lending standpoint, sometimes it can be tough for a conventional bank. However, keep in mind, we're only talking about loans and lending and credit. That's the one half of the banking model. The other half is deposits. So when I hear an entrepreneur, small business owner say, I'm not bankable, I sort of bristle at that because, from a lending standpoint, it may be tough, and they would be better suited with an alternative lender. But the lifeblood of any bank are the deposits. And so if you can find a good banker that's respond to your needs to help you with the cash flow needs that you have, both cash coming in from clients and investors, or either bank loans, other bank loans, and then how you pay those monies out to employees or other vendors, you need to have somebody that's pretty responsive, very responsive to your needs, that can grow with you. So if you're not if you're not bankable from a lending standpoint right out of the gate, you're still well served to find a good banker that wants to understand your business, do a good job from a treasury management or deposit standpoint. At some point, all goes well, then cheap bank debt could be a solution for you.
Hey, Trey, can I throw one in there?
Yeah, sure.
It's kind of coming in from the reverse of what you're not looking for. What are the biggest red flags? And then any recommendations on the remediation that you might be able to do to put yourself into a lending yes category with banks?
Again, quickly, I think the easy answer to that for owner-managed business is credit. So we run a credit score for that owner and the business, not for the business obviously, but if the business, if there's a lending need for the business, the owner will be the guarantor on the business for the simple reason, one, it supports it from a credit standpoint. Number two, puts them on the same side of the table as the bank. Sometimes it gets some pushback from small businesses about this personal guarantee for one reason or the other, and what they're saying is we want the bank to take all the risk, and that's just not something we're going to do. Credit, I've seen situations where the business is generating money, but the owner, for whatever reason, typically because of divorce, has a 500, 600 credit score. And so that tells the bank and me that owner's ability or willingness to pay back debts is not that good. And so we've had to decline some loans that are otherwise would be pretty good if you just looked at the business itself.
Call me.
Call, yeah, exactly, yeah. No, but.
Call me.
Yeah.
People, let's say you're on maybe the different end of the spectrum, and you're multi-revenue stream, you're making money, and you're turning this business to a mostly turnkey operation. Which loan product greatly increases the likelihood of you successfully being able to franchise your business in a favorable manner? Is there one loan product or one product that increases the likelihood of being able to be that efficient? Whether it be CFD, whether it be CDFI, whether it be a conventional bank loan, or whether it be SBA 7.
If you're trying to ultimately go into franchising, I think you could, I don't think that necessarily would that one option would deter you versus another option. If you're looking to franchise those and then partner with somebody that's going to fund those, I guess, is that what you're asking?
The whole worry I have right now is when I get this, because I've never taken a loan for this business, but when we do, I want to be able to, if we're ready to pull that trigger, be able to pull that trigger without trouble. And right now, I'm absolutely paranoid. There's so many stories of things not going well, people get an influx of money. And I'm just curious to see if there is a product that is more likely to increase the likelihood of a successfully efficient movement to a franchise model.
I think every case is different. I think you have a banker, you have a good banker. If you got a good banker, you should be able to sit down with your banker and say, this is what I got, what's my best path? Because you don't want to say, okay, I'm a franchise and everybody's got to go through the SBA because it may not have to be that way.
Not to make this about just Nashville Ventures, but we're in a unique spot. I've never had to use a bank. I got a business credit card, and I barely use that. So we're in this unique spot where we want to go 0 to 100, but how do you do that well, considering we're looking 3 years in the future, 5 years in the future? So that might be a case-by-case basis, which is fine.
How do you do your depository? Is like online banking, or so you don't have a local?
We use Studio,
Studio, okay.
and Studio's been great to us.
Okay.
Another veteran-owned operated business like ours. Yeah, we like that guy. He's good.
Do you have a banker there? You have a bank? Okay. You have
Yeah,
a-
Nicole Brooks over there is our point of contact, but like I said,
Oh, your point of contact.
we don't really, we've never flirted with loans before.
Well, and just to kind of add to that, I think every situation is different, but it's also about the right product based on your situation, and once you get that product, that you are using it properly. Because like, for you, you haven't had any loans till now. You might go out and get a line of credit for the business, but making sure you manage that line of credit properly, the way the bank wants it to look, so that for future reference, you've managed that line well. It should look like a roller coaster. It should look like a heartbeat. But a lot of people get a line of credit and they max it out and they don't pay it down, and then that's a harder conversation later on. So just having the right conversations and managing the debt that you get the right way, I think is very important.
One last dumb question, is a CDFI or an SBA 7A loan, or maybe not a 7A, but an SDFI, or does a line of credit decrease likelihood of your ability to get a 7A loan later?
No, and lines of credit, to her point, you want to understand what you're actually needing the working capital for. Is this permanent working capital, or is this short-term working capital? If it's short-term working capital where there's going to be some sort of conversion to cash in the immediate future, you need a line of credit. If it is more permanent where you're going to be using cash flow to pay down that loan, then that needs to be term debt. So I think a lot of people say, I need a line of credit. I hear that all the time. I need a line of credit. I'm like, why do you need a line of credit? And then when I talk to them, I'm like, no, you need permanent working capital. The line of credit, you'll rake it up and you'll never pay it down. So I think, like she said, having a good banker that you can say, this is what my need is and why I need this, they can put you in the appropriate product for whatever your need is.
Appreciate y'all.
And now I do want to, we're going to do the matchmaking here in a few, ask a couple more questions. So you'll have opportunity to meet with every single one of them up here in small groups and then ask those questions, get more in depth with those. Yeah, no, you're all good, man. But I just have like 2 more questions to ask and then we'll break into that. So my question is, what do you all typically see like startups get declined for when they apply? Is there something different besides cash flow or bad debt that's already accumulated? Anything besides those 2? But then we'll talk about those a little bit.
Liquidity.
The lack of a business plan and good projections is another one, if you don't have those in order.
Yeah.
For me, the absolute non-starter is late payroll tax filings. If you've got past due payroll taxes, I mean, I can't even start.
Call me.
Yeah. Yeah, the reason is though I'm not a lender, I am a secured party, and so I've got to have recourse to the AR. And if you have past due payroll taxes, then the IRS has the ability to usurp my lien and levy your business. So that's, unfortunately for me, that's probably one of the few things that's just, and until you get a subordination or get that paid off entirely, I just really can't help you.
How often do you see that? Good bit. Pretty good bit, yeah.
Can you take, what if there's already a lien against all business assets for some sort of term debt that's on their balance sheet? And then they're coming in and saying, hey, we're growing, we want you to finance this. Most of us are gonna require the AR, but that may be already coupled up and they're not willing to subordinate for whatever reasons. Can you do that?
No,
Okay.
I would have to get this subordinate.
Okay.
One reason I see maybe people get rejected, like you have somebody just picking this out, IT, and they decide they want to start a food truck. You're like, what do you know about a food truck? You probably really do IT well, but food industry is so hard. You don't realize. Excuse me.
Actually, there's another question I have. Is there typical types of startups that you all see that apply for loans? Is there like a pattern?
Hospitality, everybody wants to start a
Yeah,
restaurant.
like industry.
Restaurants,
Yeah.
food trucks.
Hard assets, somebody with hard assets being that, things you can touch, lumber companies, equipment companies, things, they would come to us, a bank or any lender with the understanding, it's like a house, the house is a form of collateral, just like that hard asset within the business form of collateral. The bank's gonna take that, just like you're gonna take a lien on the AR. But that's only if we have to go get it. We still have to solve for the cash flow problem, or the cash flow that we would ask for from a banking standpoint. And then any of us, with the exception of you maybe, would have to really calculate based on the information you give to varying degrees. Pathway's probably a lot less than Republic, One National, Pinnacle. But so that's where I think all of us, if you come to any of us, I think we will sit down with you, understand your situation. If we're not a good fit, then there are solutions.
We'll call her.
Call me.
We'll call Shay.
I get a lot of calls, don't you? That is the next question. What don't you take?
What don't we take? We will do hotel financing. We will do hospitality. I would say we're not crazy about vape shops. We'll do liquor stores. As long as it's legal activities. I think speculative stuff like development of apps and stuff, I think are really challenging. We'd want to see somebody with some deep pockets. But industry, we will do mostly anything. We'll look at bankruptcies, on the traditional financing. I think look-back period's usually 7 years. For us, it's just a couple of years. I mean, if you just filed bankruptcy yesterday, we're probably gonna have a hard time doing that. But, so yeah, we'll do mostly anything, but again, we are mission driven. So it needs to hit in a low to moderate income area or be a minority owned business. And that is where our mission is. If it's doesn't fall in that space, then we kind of cap what we'll look at to 500,000. Otherwise, we go from 0 to 5 million.
What are your rates typically?
Great question. We are very competitive from conventional financing on the real estate secured side, but on the non-real estate, we do risk-based pricing, but you're looking at probably 12.5%. We're a little on the high side because the risk is obviously a lot higher.
How about the percentage on the real estate side?
Right now, probably 7.5, 7.75.
That's pretty good.
Yeah, not bad.
Okay, before we break into the matchmaking, I just kind of want you all to kind of reiterate a little bit just what your all's program is. This could be mainly things you all specialize in specifically, or things that you all do not do. Just so when the founders ask you all questions, they have a better understanding of what questions to ask the specific panelists up here.
Start down there.
Okay.
And again, what don't you do? I'm still.
As long as we don't do nonprofits.
Oh, okay. Well, there you go.
There we go. We only work for-profit companies. And to be honest, I've had clients call me and I say, hey, you can get this cheaper somewhere else. Like you don't need CDFI financing, because part of one of our values is to do no harm. And so if we're gonna put you in a product that I know you could go talk to any of these guys down the street, that's where we're gonna send you. We are literally there for the mission to help bridge the gap, and get you to a place that where you are more bankable. Like I said, we don't have prepayment penalties on our loans for that reason. So whether you're in growth mode or there's a cash flow dip or whatever the case may be, you come to us temporarily and then we send you back to your banker when you're ready to do that.
So,
Yeah, we do anything pretty much.
so at Republic Bank, of course, we are SBA approved lender, so we get to go ahead and decide on our SBA loans. We also have a special program called the Community Loan Fund that is designed for those who are in the low to moderate income areas or serve those who are in the low to moderate income areas. So that's another product that we have as well. So anxious to talk to you all about it.
Yeah, so again, kind of what I do is just really kind of niche. I mean, these folks can do a lot more than I can. You know, if you need to borrow for a piece of equipment or if you need real estate, I just can't help you. What I do is strictly to support businesses grow through B2B AR financing. Again, I'm really a good fit for early stage and fast growth where, you know, maybe you've walked into a bank and they ask for 3 years of financials. That's pretty standard. Well, a lot of my customers don't have that. They haven't been in business 3 years, or they're growing so quickly that they're having to go back to their bank every 30 days because they need more and they need more and they need more. And a bank is just can't be as nimble. They just can't work as quickly as me. So I'm very specific in what I do, but you know, I'm a good solution for the right company.
Are you a bridge?
At the right stage.
Sorry to interrupt, or would you be considered bridge financing toward?
Yeah, absolutely. I'm glad you said that. Yeah, so you don't want to be with me long term. That's not my goal. You want to be in a factoring arrangement while you're growing, and then when our customers, you know, when you have a stable balance sheet and your cash flows are kind of consistent and a bank can underwrite that historical performance, absolutely, that's a scenario when you need to move on from me because I'm a more expensive cost of capital, form of capital than a bank. So yeah, absolutely. You don't want to be with me forever. I have some that have been with me for a long time, and unfortunately, those are not the pretty ones. You know, it's, for whatever the reason, they're paying themselves too much. Or
Pretty to you.
it's good for me. Yeah, good for me. But truly, I don't intend for my customers to be with me forever. I think factors get maybe a bad reputation. There's a stigma about us that, you know, you get stuck in a factoring arrangement. That's not what we want. I want quick turn AR. I want to support your growth. And when you get to a point at which you've kind of stabilized, then you should move on from me and find a bank. So.
Do you cover the whole state?
Cover the whole country, really.
Oh,
I can go anywhere. Yeah.
Wow.
Question.
Do you work with a lot of trucking companies?
Actually, no. But factoring is huge in the trucking business. I'm just unique. We do none of it. It's just very high risk. There's a lot of fraud in that world.
It's just that my brother has been using the same factor for 20-something years. And it's because of fuel costs and more payroll or whatever, but he seems to like it.
Yeah, factoring is probably not a good example because those folks do stay in a factoring arrangement. So it's not that your brother is mismanaging the business at all. It works really well.
He needs the cash, like, you know, on hand all the time.
Factoring works really well for trucking companies. Like I said, there's a lot of risk in it, and for that reason, and a lot of competition. So for that reason, we've kind of avoided trucking as a whole.
We have multiple programs for small business lending. We also are a preferred SBA lender, so we portfolio those loans and manage those in-house. And then we have our empowerment program, which I already mentioned. Again, those are for minority and women-owned businesses. Those deals are up to $5 million, so that's a space that we're very competitive in. Oh, and if you are building a subdivision or you're a general contractor and a builder, I cannot help you. So
That's the only thing
that's the only thing I can think of off the top of my head. Yeah, that's the industry we don't like.
Just sit here, it sounds like we're the most boring of the lending options you've got. So it is what it is, but I think that's sort of an example of this, the full range of options you've got on our side. We can, SBA loans, we do those all day long, as I said, growing into the largest lender. And unlike other banks, we don't have specific programs for specific groups. Come back to what I said earlier, which is some of our largest accounts with our banks, with our bank and within my own portfolio started with that free business checking account. And so that's, I would tell that to any entrepreneur or business owners, having that relationship with a banker. I think it's maybe giving banking profession maybe more credit than it deserves, but the fact is, banker, CPA, lawyer, insurance. I've been told by many business advisors, those are the 4 advisors you want as you're starting your business. And again, for us, we'll do everything we can to try to fit you or provide a lending solution that works for both you and for the bank. But even if it doesn't, we still want to start that relationship on the treasury management, the deposit side.
All right, thank you. And, you know, like I said, we're not done quite yet. Let me give a round of applause for our candidates.